This is the How to Trade Stocks and Options podcast brought to you by 10MinuteStockTrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10MinuteStockTrader.com, Christopher Uhl. Today's podcast is produced in partnership with my friends at Trendspider. I use Trendspider on a daily basis, and honestly, I could not imagine trading without it ever again. Their platform has charts, automatic technical analysis, backtesting right there on the screen, and alerts that are sent straight to my phone, all of which I use every single day. Now you can get 2 weeks to try Trendspider for yourself for free and get discounts of at least 15% off when you sign up for their service. Listen, they are so confident that this will change the way you trade, they'll even give you a one-on-one demo with the platform and answer any questions you may have about how to incorporate their platform into your trading. And that's exactly what I've done. So head on over to trendspider.10MinuteStockTrader.com to get your discount code. And I'll even throw in some extra bonuses worth over $100 to incentivize you to take their free trial of Trendspider today. Now listen, the only place to get your discounts and the free bonuses is at trendspider.10MinuteStockTrader.com. One more time, that's trendspider.10MinuteStockTrader.com.
Hey everybody, happy Sunday. Thank you for joining in. And I have the chat on my phone. So I see a lot of new people on today. So thank you for everybody that is new for tuning in and checking out what we have to show you guys today. We do have a special guest, Steve Burns, who is going to be going over a few different things today. The main thing is how he finds an edge in the market. And his main thing is definitely the back tester. So he's going to go over the 5 and 20 EMA crossover. And then in segment 2, Steve is going to show you guys how he implements this edge into his trading. And so that will be going over a recent Roku trade that he made. And then as we go into the second half of the show, as always, we're going to do a broad market recap, go over some of the broad market ETFs, SPY, QQQ, IWM, and we will take a look at VIX. And segment 4 is going to be, as always, the top 3 requested charts this weekend, which this weekend it was BABA, AMD, and Delta. So as we move on to segment 1, I want to thank you again so much, Steve, for joining us, and I will hand it off to you to show us how you find an edge in the market, especially right now when the market's just crazy. Hey, Steve, you there?
Yeah. Hey.
Hey. All righty. So today, when you're going over the charts, and I can see your screen now, what are the main things that you're going to be talking about when you're finding an edge in this current market?
Yeah, really, profitable trading comes down to having large wins and small losses. That's really the key to everything. And you want to have a quantified, repeatable process for finding the swings and trends in your own time frame, whether you're a day trader or a long-term trend follower. So I look I use the back tester on Trendspider to find those kind of repeating patterns that allow you to capture the trends. So today I'm talking about the 5-day, 20-day crossover, and I've got five different tickers I'm going over here. This is the 520 crossover. The 1050 crossover was one of the more popular ones I saw across most charts that have an edge, but the 520 is a shorter term one that actually has a good history of catching momentum and strong trends. Even the QQQ, a slower ETF index. If we look at the QQQ here, this is the 520 crossover. The blue line is the 5, and the red line is the 20-day exponential moving averages. So you see when they cross under, it tells you to go to cash, stay safe. And then when they cross back over, you go long. That's how this back test works out. So we go down here. Let me reset it to show you the exponential moving average crossed up over the 20-day exponential moving average. And then the exit, that's the entry signal. The exit's when the 5-day EMA crosses back under the 20-day. This is a mechanical back test of that signal. So the first one is the Qs. if we look at this, we have a 401% return based on the signal versus a 320% return on buy and hold. So you see the equity curve here, during the dot-com meltdown, it would have told you to go to cash. You might have had outperformance on buy and hold initially during the dot-com, but it got you in cash during the big meltdown during the dot-com era, and then it got you back long early on in the next bull market. So you can see the difference in the equity curve of the 520 crossover versus the equity curve of a buy and hold on QQQ. And, buy and hold's hard to beat. It's very hard to beat an S&P 500 index over the long term. Most people can't beat the index, and the crossovers can give you a chance to get in long during bull markets and go to cash during bear markets. And this strategy has 40% winners, 60% losers. The average gain is 6.35%. The average loss is 2.27%. And even with that, the smaller gains and smaller losses, look at the long term, you're up 401%. So that's the principles behind the 520 crossover. If we look at Apple, one of the best performing stocks in history, it's very hard to beat a buy and hold Apple trade going back through its history. And here, going back to 1994 in the IPO, if you would have traded a 520 EMA crossover, look at the difference in the equity curve versus buy and hold Apple. Apple itself, as an investor, returned a measly 15,000% over the history of the Apple stock, while the 520 EMA crossover returned 59,000%.
Wow.
So it's just stunning what you can do when you're letting your winners run and you're cutting your losers short, and you're avoiding the big crashes and pullbacks and drops. Especially even during the recent meltdown in late February and in early March in the stock market. This would have told you to go to cash when the 5 crossed under the 20. So that's a risk management tool as well as a trend indicator. Then told you to get back in here on the swing to the upside. So that's really stunning going back to 1994. Then even financials, Goldman Sachs, the premier investment bank, it returned 1,530% using the 520 cross, and only 159% versus buy and hold, because during the financial meltdown, you got just annihilated back when Goldman Sachs got down to what was about $70 a share. So you avoided that. You were at equity highs here and went to cash, and didn't have that drawdown. So you came out a lot ahead as the 2008, 2009 financial crisis ended in March 2009, and you started going back higher again. You're starting at a higher point. So, drawdowns are difficult to come back from. If you're long something and you have a 50% drawdown, you have to have 100% return to get back to even. But if you're not in something and it drops down 50%, and you get long, you can have 100% return coming out of it. So the math of getting out is incredible, and the 520 gives you a mechanical crossover signal. So, that's some tech stocks, the leaders, the financial. But how about some of the new speculative names like Beyond Meat or Virgin Galactic? Beyond Meat has a much shorter time frame here, going back to just to where it IPO'd back in May. And look at the difference. You would have outperformed buying into Beyond Meat on its big run up, but eventually using the 520 crossover, you would have had less of a drawdown, and you would have stayed here and went to cash and waited for the next signal instead of having this big drawdown. Then you would actually end up coming out way ahead, even on a new name, showing the edge that the 520 crossover alone has versus the buy and hold, even in a name that's not really back tested on data, but it's just the 520 itself can capture the momentum. Look at the outperformance here. You have just on that short time frame, you would have had a 98.73% return versus 17.12% for buy and hold on meat. The last one on the back test is Virgin Galactic. What a move that one had recently, and the 520 cross captured the majority of this move. Another thing I like to say, if you use this as your entry signal, you can still manage your exit. If you're happy up here and you've had a big win, and you're starting to see readings of overbought, you can lock in a profit on a trade. You don't have to wait for it to get all the way for the 5 to cross back on the 20. The 520 crossover and then cross under as a large overreaching model is a profitable trend following system. So you can just capture the move, as much of the move as you want. And sometimes you'll miss more of the move if you get out early, if it becomes overbought. or if you see the first red candle, you might want to get out. You might not want to hold all the way till the cross under. It might cost you in the long term. You won't capture as big of wins, but you also won't give as much of the givebacks, because with trend following like this, you do have to give back some open profits. That's just part of the game. If you want to have a really big win, you got to risk your open profits for the opportunity to have a giant win. People make the mistake of wanting to get out too early and they don't catch the really big wins. So, you have to adjust it for your own time frame and your own, risk tolerance and return goals. But the back test on Virgin Galactic here is going back to November. Look at you didn't participate in this plunge back here before when the 5 was on the 20 when it dropped, but you did get back in here once the 5 crossed over the 20. And look at the difference in the returns here versus the buy and hold. And here you just went to cash. You didn't take the big drawdown on the plunge. You just went to cash. So it's a risk management tool as well as a tool for big wins. Trendspider is just the fastest tool for doing this, because you can backtest so quickly here. You can have a watch list set up and just click through them and instantly backtest, and your chart's right here. So I do like the Trendspider platform. You have an all-in-one with your chart as well as your backtester, and how fast you can do this with Trendspider. So that's just one way to find an edge, is using the backtester to see what creates the big wins and the small losses. And you have endless options on the backtesting tool on Trendspider. You don't even have to learn to code. You have endless options here to use your entry and exit signals. So that's the first segment, Jake, that I was going to talk about.
Awesome. And just a quick question. So when you're generally trading this 520 crossover, it is generally on the daily chart, right?
Yes.
Got it. Cool. Well, definitely that was fantastic. And that kind of sets us up into segment 2, which is trading that edge and how you trade that edge. So it looks like Roku was a trade that you recently made with this setup. I'll let you go ahead and share your screen again, and we can kind of go over the process that you were thinking when you were going into Roku. And Roku was a great trade last week. I think the one thing that I want to mention here is the fact that there were so many different signals on Roku last week, whether that was a moving average cross, whether that was using the volume by price, whether that was using, the raindrop breakouts. There were so many different participants in the market to, watch Roku and participate. I think that's what really made it run. There was just so many different signals going off, and it made almost everybody want to participate in the market. So what was the main signal that you were kind of watching, Steve?
Yeah, what I was looking for is it ties in really well with what I was talking about, this 520 crossover. If we look at the back test on that, I run this on my watch list. Look at the Roku 520 back test on here. It returned 618.52% versus 428.78% for buy and hold on Roku. And Roku was on my watch list because I was looking at names like Amazon and other names that would benefit from this quarantine. Everybody's at home and having to be on computers, on laptops, on entertainment, like Netflix or shopping at Walmart, or on Zoom. So Roku was on my watch list because it really catered to the environment we're in. They should not be affected by their earnings with this quarantine. They should actually be booming with all the people forced onto their platform. And they are the platform for the streaming services themselves. So it's actually one step even above Disney Plus or Netflix on Roku as a platform. So it's something I've watched for a long time, and that's why it was on my immediate watch list of things I was going to signal to buy because of their edge in this environment, which is historical. So the 520 crossover was what I actually keyed off of here, and I went long when I got the signal of the 520 cross. I bought at the end of the day on Roku at 96.56 when we had the signal for the crossover here, and so I did go long. It was 96.56 near the end of the day on the crossover, and I held as it. I was shocked at how far it went and how fast, and I had no reason to get out. It was closing above the 5-day exponential moving average, the 5-day cross back under the 20. Initially, the 520 cross under was my stop loss, but it went higher and not lower, so I didn't have that stop loss triggered. You want to have a low probability stop loss, so if it doesn't get hit, you have the opportunity to make money. So it kept going in my favor day after day. And I finally sold it here on Thursday with this pin bar reversal and this just huge move up. I mean, I was up over 30% intraday on this one, and it just kept going higher. It did have a pin bar reversal, and it did on the RSI. It did get overbought here. You know, I look at the overbought area as where your risk reward diminishes. You know, I enter on a trend following signal, but then as the risk reward diminishes, then I look to lock in profits if I have a reason to. And that big pin bar reversal by the end of the day was my reason. So I did exit Roku here at 126.13 near the end of the day. I did get back some open profits waiting to the end of the day, but I got out at 126.13. So it was a 30.62% gain from my entry on the 520 cross to my exit on Thursday. And I was happy when I saw the drop Friday and it didn't make any new high. Each of these made a higher high and a higher low after I was in until Friday. So I got out. So I didn't like the selling here, didn't like the overbought reading. So I didn't wait for the 5 to cross back on the 20. I went ahead and locked in profits.
Yeah, no, the thing about Roku, you know, and I mentioned this in the weekend video, the main thing about Roku and some of these leaders is you can only be a leader for so long before, like you said, you get overbought. I mean, so Roku was a leader, Amazon was a leader, Nvidia kind of a leader. So the question is, do these leaders take a pullback next week? And do some of these laggards help the market move to the next level? So that's one of the main things that I think is really interesting into next week is you clearly had a very defined set of leaders, Roku being definitely one of them. And, you know, this comes into the fundamental aspect a little as well as you talked about, Steve, where, you know, this wasn't just a technical setup. This was also just from a fundamental and from a, I don't want to say sentiment point of view, but everybody's at home right now and they're streaming. You know, Roku is the poster child of kind of coronavirus stocks, in my opinion. So, you know, that as well, on top of the technical signals people were seeing last week, that just overall fundamental sentiment kind of, you know, strength definitely helped Roku as well. But the question next week is definitely, you know, is the market a little too overextended? Is it not overextended? You know, that is the big question. Bulls and bears are going between, you know, each other right now is, oh, and the market's just, it can't go up any higher. You know, it can't go any lower. So I don't think anybody knows what's going to happen. As we've seen, you know, a lot of people got the bottom wrong. A lot of people got, you know, the continuation wrong. So this is not a market where, you know, everybody is just playing the status quo. The status quo changes every day, even more than it usually does in the market. So I'm going into segment 3. Steve, I'll let you drop your screen. We'll jump on. Unless there's something else that you want to mention, we'll jump into segment 3 here. And that's really going over the broad markets, looking at SPY, looking at QQQ, IWM, and taking a look at VIX. This SPY chart that I have here, just to kind of start the conversation, is really interesting. One, because we just broke through the anchored VWAP from December 24th of 2018, which was a huge area of support initially. Now it did act as resistance before breaking through on Friday. But the coolest data point, I think, out there on SPY right now is the overall return from the very low back a couple weeks ago. If you look at 2018 versus 2020, I'm not saying that there's a bottom in right now, but there's clearly a short-term bottom in. So what's interesting is if you look at the very bottom, the intra-week low in 2018, and then you look 3 weeks after that weekly candle closed, the return was 13.99% from very low to very high. That's a big return on SPY in 4 weeks. Now you look at the current drop in 2020, and you look at the return since the intra-week low, and then you look 3 weeks after that intra-week low formed. We're literally up 31.57% in 4 weeks. That is 125% more of a move than we had in 2018 on SPY. So just to kind of, show the absolute madness here, I mean, this is really kind of uncharted territory, and it really begs the question, is this just a bear market rally? I mean, having this big of a move that quick is incredibly impressive. So kind of, I think that's what everyone's trying to figure out. Is this really a V bottom, or is this going to turn into a W and possibly even lower? Nobody really knows that. That's why we use charts. That's why we use different types of analysis to kind of try to get an edge. But at the end of the day, nobody knows what's going to happen. And if they tell you they know what's going to happen, then they are definitely somebody you want to run away from as quickly as possible. So that is the SPY chart. I'll jump into more charts here in a second. I'm just going through the key notes here. IWM is one that I'm really going to focus on because it's lagging SPY and the Qs. So as we just mentioned, the leaders and the laggards have really been things you want to pay attention to. If you're identifying a leader and then all of a sudden you see a laggard that looks exactly the same as that leader a week ago, that's something you want to pay attention to. So going into the second note here, the VIX held relatively well, I guess, if you want to call it that. It's still within that kind of dip that we identified last week. I'll go over that. And then just talking about those leaders and the laggards. So I will go and share my screen now for the actual SPY chart and some of those broad market charts. As we mentioned, we just went over this chart on the presentation. The main thing here that I didn't mention before is notice that we've got these blue raindrops that are forming on pretty much every slight pullback we had. And then we had that, at least in early April, this signaled the bottom here before moving up to this anchored VWAP that initially acted as resistance. And so what I really want to mention as well, if you guys have been watching and paying close attention to these charts, you can see how they've changed over time, right? This break-even zone, this demand zone, was previously a supply zone. We were down here at 261, and this big block of volume was people who were stuck. And I mentioned this in the weekend video, but imagine this, right? We're starting the volume profile from February 19th. So no other price action matters. We're only measuring the price action from this point in time. So if you look at this big green zone here, this big green zone is representing these three candles right here. How do we know that? Because there has not, well, now it's not, but before it was only representing these three candles. And since there was so much volume sticking out here, we knew that a lot of people bought the dip too early. And so as the price continued down, anyone who bought originally around this cluster of candles was down 21 or 22% within a couple weeks. So as those people started to break even, that initially created a supply zone. You can see that the price really had some trouble breaking through it initially. But then as demand started to outpace supply at this area, you have your ability to break through that zone. And so now we call this a demand zone because this is where buyers were able to outpace sellers and move the price up. So this is what we're calling the break-even or demand zone. And then you can essentially just call this a break-even or supply zone above, except these people above are breaking even from a loss. If the price goes down, these people in the demand zone are breaking even from being profitable on Friday and, if the price came down. So that is what I wanted to mention here on top of what we had already gone over. Moving on to the Qs, I wanted to go over a couple different things. One, you can see that we're kind of already in this supply zone on the Qs, and you can see how much SPY is really lagging the Qs right now. So technology has definitely been a leader. Technology is a lot easier. Technology companies are able to be a little more flexible during a time like this. They were able to, change some things that necessarily weren't possible in maybe some of your retail and your oil company stocks. Whereas some of your tech companies were just able to really, say, okay, well, that sucked, but we're able to maneuver through it and even take advantage of it. So that's what we're seeing on the Qs on the daily. We're hitting that break-even zone. This is a crucial area to break through. Notice we've got that gap around 223 to 229 above. as much as I want to be bullish, I mean, that is going to be absolutely incredible if we get near back to all-time highs in the next week or two. I mean, it's really fascinating to see just this whole market move over the last 3 weeks. So the main thing I wanted to mention on the weekly chart is the fact that we did actually break through this previous area of resistance. Remember last week we were looking at this area right here saying we bounced right to it. Well, this week the trend line had no chance against the price action, and we just went straight up. So we are still in this very long-term kind of channel. It's kind of this broadening ascending channel that we've got here, and until this channel breaks, the status quo is kind of kind of the same. We didn't even break it on this big crash from the coronavirus, so it's I really want to know what's it going to take to break down through this zone. Obviously, a big kind of revamp of cases, if we do open back up, could do it. Bankruptcies coming in could do it. But for right now, that is a really strong candle to go against. But we'll just have to see what happens into next week and see if SPY starts to catch up a little bit. But all in all, remember, we looked at SPY, and it was about a 31% return from the bottom. Here, we're literally exactly the same. So, just because there are leaders in the Qs does not necessarily mean the Qs are leading SPY. They're almost exactly the same return. So that's QQQ. IWM is going to be the laggard that we talked about here. And essentially, we can say that it's a laggard because it hasn't even broken through this anchored VWAP from February 20th. And remember, the anchored VWAP on SPY and the Qs were broken through a week or so ago. So this is clearly a laggard. If we compare the overall return from that low, remember 31% was on SPY and the Qs. Here we're at 30%. So we're really not lagging that much on the overall index. We haven't broken through this anchored VWAP like we did on the Qs and SPY, but it's still a 30% return from the capitulation bottom here. So that is something to keep in mind. I did want to mention here with the volume by price, one thing that I've started to do with the anchored volume by price is anchoring it from when you start a trend line, because then you're able to essentially say, I know the volume profile of this trend. And so you're able to say from February 2018, most of the volume is still holding way up above in this 150 zone. And so a lot of the time you'll see, not always, but this zone above where most of those people are holding at a loss. I mean, if you look at this, most of these shares right now are holding at around a 20% loss right now. So unless people start to continue to sell at a loss, as long as that supply starts to dry up and any demand starts to come in or it remains constant, you're going to see the price continue to move up. We do have that gap above as well. That's important to look at. Turning on the gap snake, you're able to see that gap very clearly around 136 to 141. And, if this thing does make a move next week, that would be an area for the price to kind of have gravitate towards, if you will. So last one I wanted to go over in the broad markets is the VIX. The VIX has been one that I really liked to go over because essentially, let me change this real quick. I got to change this from a raindrop. Let's get this back to a hollow candle. There we go. Let's go back to VIX. So this is a chart that I made last week. We're going to essentially just compare the weekly versus the weekly candle on VIX in 2008 versus the weekly candle on VIX now in 2020. And what you'll see here is something pretty interesting, right? We've got, let me just optimize this a little bit. We've got this same kind of like setup thing going on here, this weird like rip, pullback. And I just pretty much just made this a repeat kind of thing. And so you can see that it's been, and let me just delete it here just to go over it. It's been 4 weeks in a row of just straight red on the VIX. If we were to look at maybe a time for a reversal, it's probably after 4 red candles. Notice here, after 5 hollow candles in a row, we had a pullback. So are we going to have a 5th just absolute bloody week for VIX? Or are we going to have something like this where we've got this kind of dead cat bounce before actually continuing to move down lower and lower? So remember, the VIX is something that, and I've mentioned this a couple times, you don't have to have a higher VIX to have a lower SPY. So just keep that in mind. It is important to kind of look at what the VIX is doing relative to the SPY. That was a little disconnected at one point, but it seems to be a little closer to, a little closer to reality now, if you will, because notice here that we didn't really drop that much compared to overall, the overall move in SPY. So, we'll see what happens. That's the VIX. I really don't trade the VIX or anything. I just look at it as a gauge for SPY. And so, that's what I really wanted to go over here. As far as the broad markets go, Steve, is there anything that you want to add? You're welcome to share your screen if you'd like. If not, we can move on to segment 4.
No, I just wanted to say, it's really important these times. Like you said, there's so much uncertainty and unknowns that you should follow your price action system. Even if I'm maximum bearish thinking the second Great Depression is upon us from a macroeconomic level and the market rallies and has a 520 crossover, I take it. I mean, That's really the key to people that make money versus people that don't. They get stuck in their opinions and don't trade, and anything can happen. And like you said, it could go to the 200-day moving average and reverse back again and make new lows. I mean, anything can happen. So our job is just to follow the trend and follow our price action systems.
Absolutely. That's a great point, Steve. And one thing I want to add to that is, I've been trading in the markets long enough where I've done some horrible things with crashes. I thought, oh my gosh, this crash of 20% is just going to continue. So I've been there. I've been that person who's just absolutely so mad because the SPY just won't drop. And the more people that are so mad that the SPY won't drop, the more it's going to go up. And that is simply just a function of people getting caught. They're adding to their short positions, and they just keep getting squeezed and squeezed and squeezed. I don't think, your average bull right now thinks that, the market is healthy, but they're also not going to go against the trend. I mean, it depends on what you define a trend as. The short-term trend has definitely been up. The longer-term trend is still in a downtrend. But I mean, when you've got these V-shaped recoveries, they can go on for longer than you think. And that brings up a famous quote where, you can be irrational longer than your account can be. I forgot the exact quote. Sorry?
Market can be irrational longer than you can stay solvent.
Solvent. Yes. I couldn't think of that word, solvency, which is a big thing in the market. If if you're trading margin, if you're going on leverage, you really either one, have to be confident, 2, hedged really well, or 3, you're going to blow up your account pretty quick. So, just from that perspective, remember, the market does not have to follow rules. The market makes its own rules. And, going against the market at the wrong time can really be brutal. And, I've seen a lot of people kind of have that, at least now. I'm not saying the market can't reverse 5% tomorrow and we start moving down again. But just from kind of the overall sentiment, there still are a ton of bears out there. And, as we mentioned, the more people that are trying to revenge trade this, the more they're probably going to dig themselves a hole. So we'll just sorry?
And also the short side's a lot more difficult than the long side. I had so many tweets coming at me during the plunge with all those, monster rally days, limit up futures and 3, 4, 5%, 2,000 point rally days, and everybody saying just go short, because I didn't really want to go short in that market because of the volatility. The short side is different than the long side.
Yep.
I know a long bull trend can last a year and be up 20, 30, 40%. And the short side, it was a 35% drop about in the indexes and only lasted about a month and then rallied 30%. I mean, the short side is a different animal than the long side. And people are endlessly saying, to go short when I was going long in different signals. And I was thinking it was funny. And they were all near the bottom saying, well, just short the rallies. Like, that's not how short. You have the biggest rallies in bear markets. Like you said, Jake, this could still be a bear market. We could go to the 200-day moving average up there and then reverse back. We don't know. Or it could be the beginning of a bull market thanks to the Fed interventions. And, but the thing is, we do not know, and we have to trade the reality of what's actually going on. And, the people that were short, if you catch a drop, you might make a 50% gain as short if you could handle the volatility. But if you catch the long on the way back up, you could double your money, like in Etsy or Goldman Sachs gets back to previous highs. So the math is just always better on the long side.
Absolutely. And, Steve, that seriously brings up a great point, because one, I've been there. I've tried to short the market before, thinking I, wanted to be that hero. But this is what happens when you're short the market and you're getting continually burned. What happens is you start to think negatively. You start to wake up in the morning and you're hoping for bad news. You're hoping that the coronavirus cases increase. You're hoping that the death count increases. And this sounds horrible, but if you're short, those are the news headlines that could possibly help your short position. So you end up becoming this really negative person when you're in an open short position, because you need things to go wrong. You need bad things to happen in order to make money. And I've been there before. I've woke up every morning, something bad happened. And it's just a horrible feeling. I'd rather wait until the market is exhausted on the sell side, watch for some type of divergence to form, and go long on the economy. I don't like to be negative about humanity. And that's what you really become accustomed to doing when you have a short, because you essentially are wanting negative things to happen to push the market back towards your position.
It becomes a cognitive bias.
Yep.
Where then you don't want to be wrong. You want to prove you're right. And you want to hold. Then you start thinking the market's stupid and everybody else is stupid and the Fed is interfering, and you're rooting. Like you said, you get to a mindset where you're rooting against everybody and everything. Perma bears are the most cognitive biased. I know guys that have been that way for a decade, and I don't know how they're even still functioning in the market. Yep. And they have these 1,000-word blog posts about why there's a resistance at SP 500 level, and then it rallies and blows through it by 3% after hours with the Gilead news. It's like, what life are you living in? I mean, I was in IBB because I was hoping just one of those biotech companies would have even the news. They don't have to do it; just the news flash will drive it. And to be short, you have to fight against the politicians, the executives trying to pump their stock up, the investors, the cash flows of the end of the 401ks and IRAs every month. The Fed. You're fighting against the world when you're short. I mean, and if you look at the long-term stock market history and any back test you want to do, the bears might win some small battles, but the bulls win the war.
100%. I think that's a great point to move on to segment 3 and identify some of these stocks that may be those stocks that help the market move up. We've got BABA, AMD, and Delta. The first two, BABA and AMD, have 100% been leaders. BABA is an online retailer in China. I mean, talk about people, seeing China progressing, getting a little better. So naturally, BABA was one of those plays that people were like, well, this is an online retailer and it's in China, which China's leading the world in recovery. So that was one. AMD, I really don't follow that one too much, but it has been something a lot of people have mentioned. So we're going to go over that one. And then the airlines. I mean, earnings are coming up on the airlines. Technical analysis at this point is going to be a little iffy, simply just because, the airlines are in a very bad spot. There are still some charts showing that, airlines may not be completely done yet. I mean, you've got a complete sentiment change, essentially, because you've got Warren Buffett selling partial positions here of his Delta position. So, that's something to definitely keep in mind going into next week. I mean, even though some of these stocks look interesting, we'll pull up BABA here. It doesn't necessarily mean that it's going to continue to be interesting. 1 second here. I'm having a little trouble with the update. Let me log in again. Yeah, guys, we just recently had an update today. So if there is a little bit of funkiness, it's simply just the update kind of kicking in. As you guys can see, the chart's fine now. So BABA, this is one that I'm going to go over the weekly versus the daily chart. So the first thing on the weekly, right? I want to anchor the volume by price from the December 2018 low, because that's where anybody who bought on this uptrend either did one of two things. They either likely took their profits or they added to their position, which, you know, either one, it changes the status quo. These people changed their status quo of BABA. Either they, as I mentioned, took profits, which helped cause the price drop, or they added. So this 2018 low is where the market kind of reset, if you will. And so that's where I want to start this, because I want to know from December 24th, when we capitulated, where are a majority of those people holding now? And you can see on the weekly chart, a majority of those people were holding right in this 176 zone, which is exactly where we bottomed. And this zone was here before the price got here. And so this was really a nice cushion for BABA. If we anchor the Alpha Trends anchored VWAP from this point, you can see that the price did break down through this line. But if you were using the anchored volume by price as well, notice how these lower volume bars were able to add some cushion to the price here. And this is where we ultimately bounced from. And now we've just had a huge rip to the upside. So going into BABA on the weekly side of things, that is what I'm kind of using Trendspider with, the anchored volume by price and the anchored VWAP. If we go to the daily, you know, this is simply just a pretty straightforward trend line. I'm sure a lot of people are watching it. And what happens when a lot of people watch a specific trend line or a specific indicator? People start selling, because if too many people run for the exits at the same time, supply starts to outpace demand and you've got a drop in price. So I got to say, this is a really ugly candle on Friday for BABA. And this makes me think that, you know, it may be time for some of these leaders that have absolutely ripped. They may be you know, in for a little bit of a pullback, simply because people are profit taking. People are like, holy crap, I'm up 20% in 2 weeks. I'm taking my profit. And then you've got these people playing this resistance trend line here. I mean, it is literally textbook. You've just got so many people probably watching this general line, and you just had this massive pullback here. So BABA into next week, 100% a leader last week. Not sure if that's going to be the case into this week. But at the same time, I have no idea what's going to happen. You know, that this is simply just a level, as Steve mentioned. You just got to follow your technical levels and let the market kind of do its thing. So if this was to pull back, you know, I would probably anchor the volume weighted average price from this point here that we bottomed at. And so if the price did pull back, you know, it could pull back a little bit to this area, and that would be 100% healthy. That wouldn't even be a bad thing. You don't want the price to go straight up, because if the price goes straight up, it's very easy for that price to go straight back down if enough people take profits at the same time. So BABA, interesting one. Moving on to AMD. This one is looking a lot like some of these other tech plays last week on the weekly chart, where we've got this ascending triangles trying to form here. It's not as strong as like your Amazon ascending triangle or your Netflix, but you still have this kind of ascending support. You've got this previous area of resistance, and we're testing that again. You know, what's to say that this can't just come right back and pull back to retest it? So just from a longer term weekly perspective, we are kind of at that all-time high zone where people may start to think, is the market really that strong? That may cause people to start reconsidering. They say, oh, wow, we're at all-time highs again, and things have only gotten worse. So, you know, that may be the psychology behind some of these people selling into next week. This is something I wanted to show you guys. This is like a really, really symmetrical chart on the daily. You can see that we've got pretty much, you know, one, I can label these as numbers. You know, this is your one, this is kind of your two here, and then three is your bottom. And then you can see here, same thing, right? Here's your two. Is this going to be our three? You know, I don't know. But one thing to mention here is if we turn on the gap snake, there is definitely a gap below right here around 52 to 51. So if the price did pull back, gaps do like to fill. I'm not saying this one's going to fill, but that would be my personal target below if I was bearish on this, or if I was bullish on it and I want to take profits or maybe add to my position, gap fills are always a place to look. So that is AMD, clearly another leader in the market. Let's go to Delta, which is clearly a laggard, or, you know, I don't even know what to call it at this point. But the main thing that I want to mention here is a couple things, right? The first thing we've got, I just made this up. I call it a thruster wick. And the reason I call it that is if you look at like a spaceship taking off, you generally have the thrusters kicking in and you've got all that, you know, excess stuff coming at the bottom, pushing the rocket ship up. And these types of wicks that I see, when you've got a higher low, this kind of reminds me of like a spaceship kind of trying to gear up to take off. Another cool example of that, this is kind of getting off topic for a second, but I saw this on SDC as well this weekend. This was a request by one of our followers. Same thing though, right? You've got this kind of thrusting type approach. You've got the wick that tries to retest last week's low, but it doesn't. So if you look up thruster wick on Google, you're not going to find anything because I randomly just made it up today. But that's what it looks like to me. So we're going to go with it. This doesn't mean that this thing's going to rip next week. But when I do look at candle formations, I do like to see this higher low with this kind of thrust, if you want to call it that. Obviously, there is earnings, I think, next week or the week after. So the question, you know, remains, how much of this is priced into earnings? I mean, a lot of the price movements in the market right now are based on what is already priced in, right? You know, so if things are already priced in and people start to speculatively buy airlines into earnings, you know, you could see a huge rip. And even more so, notice that we anchored the volume by price from this January 17th high. And you can see since that period of time, most of the shares have accumulated down at the bottom here. So that tells me one of two things. It tells me kind of the same thing in both cases. You have a ton of people who capitulated at this bottom. You've got a new round of people who are now holders. And so if this big, these three big bars of volume, if those are really people who are going to hold, then, you know, you could easily have supply drying up. You don't really need demand to increase. Remember, if you're looking at a supply and demand chart, all you need is one of those curves to move. So in this case, we could simply just have the demand curve stay constant and you have the supply curve drop, i.e. the supply is drying up, and all of a sudden you've got an increase in price. So for those that want to understand the psychology and kind of the moving parts of this volume by price, I would highly recommend checking out just, you know, just some type of microeconomic video or course, just to understand how these supply and demand curves move, because you really need to understand what is driving price. And it doesn't matter if news is driving price. It doesn't matter if an article just came out that's driving price that says, you know, something new came out. That article is creating a new status quo in the supply and demand, which is then pushing the price either up or down. So, you know, news, earnings, all these random things, yes, are driving price, but the underlying move is coming from the imbalance of supply and demand in the market. And that's what's really driving your price. So with Delta, we've got a ton of people holding here. I don't know what's going to happen into tomorrow, but, you know, if we turn on the gap snake, we do have that gap above right to around 28. So that is something to 100% look at into next week, simply because these gaps do like to fill a lot of the time. With Delta, notice that this is just our first gap. Our second gap is here. Our third gap is here. So this thing pretty much looks like Swiss cheese at this point. As far as any of these tickers go, BABA, AMD, or Delta, Steve, do you want to add anything with your charts and go over anything that you have some thoughts on? I think you mentioned you traded BABA last week, right?
Yeah, let me share my screen just briefly and cover that. The Alibaba. Oh, here's the update for Trendspider.
Yep. So you may need to update it and go to the new workspace again. It will just press. Oh, there you go. Perfect.
Yeah, here's the Alibaba chart with, once again, the 520, 5 crossed up over the 20-day moving average as the theme of my talk today. Once again, it beat buy and hold, 202.95 versus 125.88 for buy and hold. That's not an easy feat to buy and hold. Most day traders and traders can't beat buy and hold for the indexes, but here's a huge equity curve difference versus that. It's pronounced as some of the other leading growth stocks, but my Alibaba trade here was based on, once again, the 520 crossover. I went long with the 5 crossover the 20. My entry price was 198 on that crossover, and then I held it up until Friday. I exited near the end of the day at 209.69 with that big pin bar reversal, and it just all day it was not looking good. The way it closed, big reversal. So I did decide to go ahead and lock in profits to Alibaba. And like you said, with what they went through with Wuhan and the pandemic, I thought this was the 3 low test down here. Triple lows had a good possibility of the worst was behind us. And then when I got a back test signal like that, I went ahead and went long and held it. No reason to get out until I got up to where I was happy with the profit, and it stopped going higher and struggled for most of the day to really finish any higher. So it was a 5.9% trade on Alibaba on that one. So had to follow the 520 cross and then got out at the end. So that's all I want to say about that one. But you really just see the over and over, the 520 cross is a really good universal momentum trend signal for a lot of names.
Yeah, I was going to say, for these things that you're trading, Steve, are you generally trading just the common stock or an option?
Nowadays, I primarily focus on stocks. I just like the equity because I don't have the time pressure and the theta decay. And sometimes I will need, a few weeks. And sometimes, it's not enough. The speed's not fast enough to overcome the theta decay. And especially with high volatility, the options become so expensive with the volatility being so high. A lot of times it'll be like the earnings is priced out every morning when you didn't gap 2,000 points. So I've really been focused on equities in recent years. So I have plenty of time, no time pressure, and I can just let a swing or a trend play out. I don't have to worry about overcoming the cost. A lot of liquidity problems. I go out of the money too far, or if it goes into the money too much, sometimes I can lose a lot in the bid-ask spread on less liquid option chains. When I trade options, I only focus on the most liquid chains, so I didn't have to lose a lot in the spread.
Oh man, some of those spreads are brutal. Even some of the liquid options their spreads have been brutal. I mean, it's pretty impressive how big some of those spreads are. So,
I felt like those years, I felt like the old time the stock traders that said it used to be $100 of commission going in and out of a trade back before there were, such cheap discount brokers. And I know how you feel. It used to cost $100 to go in and out of an option trade.
Yeah, no, I gotta admit, I was the biggest piker when I first started trading options. I trade very liquid common stock most of the time, and I'm very comfortable just doing a market order. So when I first started trading options, I was doing market orders on the options, getting sold like 10% above what the price was. I'm like, what the hell?
Yeah.
So just speaking from experience, folks, do not market order options unless you want to be liquidity for somebody up there with a limit order, take it away from me. So that is something that, I learned the hard way. I don't love doing limit trades just because if I want something, I'm very comfortable market ordering it. But with the options, you really have to be, very aware of how big the spread is, what's the current price relative to the spot price, because all of that matters when you enter. I mean, you could get a 2% rip on BABA, but if you bought a BABA option at market and paid 10% above the current price at the ask, you may just be breaking even when BABA goes up 2%. So just a note about options. I've had plenty of bad experiences with them, so I'm always happy to share those with other people so they don't make those. But with a lot of things in the market, you really don't learn until you make that mistake yourself.
Yeah, I knew one of my option friends that used to trade options. One of the best option traders I knew, and he'd actually let things just go be put on him or called, so he didn't have to lose the spread. He would just let it execute and buy the stock. Yep. He didn't want to sell it and lose the spread, especially even when he won and went deep in the money, then it would have a lot of liquidity issues. So, when I trade options, I focus strictly on the back in the days of highest liquidity SPY and Qs and Apple and just the highest liquid. Like you said, it's shocking how some of the others, even like Google and stuff, will be illiquid at times. You really got to be front month or front week, close to at the money to really get the most liquidity, like you said.
Yep, 100%. So it's it's always a learning game in the market. If you think that you have just got the market down, if you're winning every single trade and it's just becoming too easy, remember that the market changes. It's a constant fluid thing. So just because your strategy just worked 3 times in a row doesn't mean it's going to work another 3 times. And this is kind of to end the whole episode today. This is why the back tester is so powerful. You're able to go and say, all right, well, the last 3 trades were really profitable, but let's go back and look at the last 5 years and see if that's actually something that is going to continue to be profitable. It's kind of like the law of large numbers, right? If you if you flip a coin 1,000 times, you may hit heads 100 times in a row. But over that 1,000 times, you're going to get to the intrinsic probability, or not the intrinsic probability, but the real probability, which is 50-50. After 1,000 flips, you're probably going to be somewhere around 500 heads, 500 tails. That's just how numbers work. That's how trading works as well. Just because 5 times worked does not mean the 6th time is going to work. And a lot of the time, people generally say, oh, well, the last 5 times worked, I might as well go all in the 6th time. And then that's when things always blow up. So, never get overconfident. Always know that the market is there to surprise you. And Steve, you are always very insightful with your knowledge and your experience. And I want to thank you so much for your time today, going over some of your strategies and some of the trades that you've made recently. And I really hope everything's good on your end, staying safe and healthy out there. And hopefully we can go back to normal at some point one of these days.
I would like to wrap it up. My final thing is say, with your coin toss analogy, that's how profitable trading works. If you have a 50-50 win rate, if you made $2 when you were right and you lost $1 when you were wrong, that's how you be profitable in the coin flip. And that's where the edge comes from, the risk reward ratio and your win rate.
Yep. 100%. It's all about probabilities. People say, trading is gambling. Well, technically gambling is playing odds. So yes, in a way, trading can be gambling, but the people who make money trading are people who can control their risk, who can identify, their risk and be able to take that and make it into a profitable strategy. If you do look at the market like gambling and you just look at, I've got a 70% chance I'm going to win this, I'm going to go all in, that is never a strategy that's going to be consistent or attainable or sustainable over the long term. So being able to back test, being able to look at those statistics are absolutely crucial in this market. I've used the back tester more than I do recently because, especially with the VIX, right? If you've got 4 weeks in a row on VIX, you go and back test the VIX and you would have seen pretty quickly that the VIX always goes down after 4 weeks in a row. And that was one of the reasons I became pretty bullish after the VIX hit 4 weeks in a row green. I mean, it's just not sustainable. And being able to go back and test that is unbelievably powerful. And thank you so much, Steve, for showing us how you personally use that and how it helps you out in trading.
Yeah, always great to be here, Jake.
Awesome. Well, thank you everybody for attending. This was a record attendance. Thank you all for making this happen. This has really been motivating for the whole Trendspider team to keep pushing and keep making things better, more utilizing, and we'll see you next Sunday. But remember, next Sunday is an event. We have the event from 10 a.m. Eastern to 3 p.m. Eastern. We've got 8 different presenters. So if you are looking to tune in next week, make sure to look at the time. It is not going to be at 6 p.m. Eastern. It's going to be at 10 a.m. Eastern time in the morning. and we will see you there. Thanks so much again, Steve, and everybody have a great Sunday night.
Thanks.
Hey, before you go, make sure you head on over to trendspider.10minutestocktrader.com to get your discounts. And I'm even going to throw in some extra bonuses worth over $100 to incentivize you to take your free trial of Trendspider today. And the only place to get these discounts and free bonuses is at trendspider.10minutestocktrader.com. 10minutestocktrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10minutestocktrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10minutestocktrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client situation or investment objectives. 10minutestocktrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10minutestocktrader.com/legal. And thanks for stopping by.